We just heard a lot from Rich Clarida on sort of where yields could go, where inflation could go in the labor market. Would you recommend investing right now for fear or greed?
Well, I think that the good news is it feels like the big recession that people feared with rates going up so quickly, it feels like we at least have a soft landing. Maybe it's recession, but it's certainly not a bad one. The challenge, I think, is whether or not the Fed can there are some headwinds to getting inflation down. Look at the wage pressure on things like the auto strike, and there was a lot of discussion. If they're successful, you'll start to see other unions striking. And sure enough, today you had the 75,000 employees at Kaiser Permanente going out on strike looking for wage increases. Those are going to be very inflationary. Oil, obviously, the price of oil shirts down a little bit, but it's still high. So, look, my gut is that the Fed raises one more time. Why not? It's built into the market. And then the question is, how quickly can they cut? And I think that even, it certainly is not going to happen before the second half of next year. As long as you believe that, people are staying probably a little bit short duration after this cut. Maybe people we're seeing investors start to go a little further out on the curve. But my fear is that this sticks around for longer than the market expects.
Okay, so a little bit of caution may be justified. Jenny, good morning. It's Guy. So what are you thinking about doing in that kind of a scenario when you think about how you are going to be setting up for that kind of a world? What are you doing, and what is your degree of certainty right now? It feels as if there's a lot of competing forces at play right now that are really difficult to sort of tease apart.
So I think there's some real opportunities out there. I mean, first of all, let's face it, you actually get paid to be in fixed income. I mean, even if you're in cash in a money market fund, you're getting 5.5% yield. But I think there's some great areas in the market. I love if you can withstand the illiquidity risk of private credit. I love private credit, and especially now as regional banks have even retreated, we're seeing in our private credit team anywhere from 11.5% to 12.5% yields. Those are equity yields in the fixed income market. So I think you're seeing that as an opportunity. Sure, I tend to believe the 10-year is actually going to stay up a little bit longer just because of the macroeconomic environment where, the deficit's gone from 30% GDP up to 100% of GDP, where it's $31 trillion, and you need buyers of that. And if we don't have enough buyers, it's going to keep interest rates on the long end a little bit higher. I think fixed income's a great place to be. How much of that's all built in a longer cycle of higher rates? How much is that built into the equity markets? I'm not sure. Mm-hmm. And so if I'm in the equity markets, I actually like a little more conservative, good cash flow, generating companies with good dividends.
So based on that point, 60-40 portfolio, just straight up now, isn't doing great. We're seeing stocks and bonds kind of move together over the last 3 months. So I'm wondering, with your view on private credit, is it like 60-30-10? Is it 50? It's like fast math. 50-40-10? What do you think?
It all depends on the individual.
Sure, but you're the individual.
No, like I said, high yield, you're getting, just under 9%. That's a really nice yield. We're not seeing increase in defaults, so it feels like that spread is actually pretty comfortable. And as long as the economy doesn't go into a recession, you're not going to see defaults in the fixed income market. Again, how much have we priced in? I think actually this recent correction in the equity market has priced in some of the interest rate and some of the more growthy stocks. That's corrected itself a bit. But again, I feel like right now it is possible that that the inflation is going to be harder for the Fed to get under control. You're definitely seeing it, but with that, you're probably going to have rates stay a little bit higher for longer.
Jenny, that kind of goes to a little bit about what Ray Dalio was saying at the Greenwich Forum yesterday. He was talking about the high rates that are achievable in high yield and maybe elsewhere, talking a little bit about private credit as well. But the point he was making was, are these really good rate? They're high rates relative to recent experience, post-GFC. Are they really good rates relating to the environment we are in now? Do you still think that the yields that are being offered right now are compensating investors for what they're seeing and are going to be compensating for that slightly higher inflationary environment that you're alluding to?
So I would say yes, because I think that we're not going to have an economy that has a hard landing. I think as long as we have a soft landing, we're going to be able to withstand. You're not going to start to see defaults on the credit cycle. A lot of the equity market companies actually went long duration on their debt. So their debt's really cheap compared to what the market is. And so, as long as you have a good cash flowing company, you're going to be able to withstand an environment of higher interest rates. As long as you don't have a lot of defaults, you're actually getting paid really well compared to where inflation is today.
Jenny, how do you view the dysfunction in Washington? And I'll tie this back to long-term yields. Clearly, there's fiscal dysfunction. Clearly, it looks like we are headed more towards a government shutdown now in November, since there's no House Speaker right now. And I'm wondering, does this just permanently increase the term premium we're going to have to see in the long-term bond market because of this, because of the fiscal deficit, the fiscal spend, and the inability for Washington to get stuff done? And how does that sort of frame any long-term thinking?
So I actually tend to think a lot of that is noise. Obviously, it's dysfunctional, but let's face it. Even if the government, couldn't come to agreement, an IOU from the U.S. government is probably the best IOU you can get. I think the longer-term issuance story is just this year. The U.S. deficit this year is going to be $2 trillion, up from $1 trillion last year. That all gets added to the U.S. government debt, and the trajectory continues to increase. So, you're going to have to find buyers of that. So who are the buyers? If the debt's 31 trillion, 25 trillion of it is required today to have buyers. That's the Fed is 25%. You take, foreign investors, Japan's only 1.1 trillion. They're the largest foreign investor. Then you're looking at corporates, mutual funds, pension funds. They're all going to have to support that U.S. government debt. And so I actually think that's the bigger worry, is just the pace in which we're taking on debt as a country.
Does that mean you want to look outside the United States, Jenny?
Well, I do think there's some really interesting stories outside of the United States. I mean, we look at it in the emerging markets, the China plus one story, right? Companies learned that during COVID, your supply chain can't rely on a single country. And so, it's not that they're leaving China, because China is actually, a cheap source of supply chain, but they're going to places like Vietnam, India, Indonesia. And so all those become opportunities to be able to invest in. And so, yes, I think there are opportunities. You go to Latin America, where you have, much of the raw materials for batteries are going to be supplied out of Latin America. So I think there's a lot of interesting opportunities in those markets as well.
It feels though if yields stay higher, dollar is also stronger, that EM is where things break. As Jenny Johnson looks at the landscape, what are you worried about breaking?
What am I worried about breaking? Here's the point. You never really can predict. Obviously, as I said, I'm worried about the U.S. debt. But I think the most important lesson that we learn over and over is have a diversified portfolio, because you cannot predict all these things. Usually when people are predicting it, it's already built into the prices in the market. So the best message I can give to everybody is make sure you have a very diverse portfolio.
But the problem, Jenny, at the moment is that diversified portfolio isn't really working. Alex was talking about 60-40 a little bit earlier on. Bonds and equities are moving in the same direction. Yeah, you could probably get some diversification by being in private markets and maybe in real assets as well. But people are struggling to diversify in a world where bonds and equities are doing the same thing.
Yeah, I mean, that's always a challenge, and it's unusual that happens. But, again, you're actually getting paid pretty well in the fixed income market. I mean, if inflation's, 4% or so, you're getting in high yield almost 9%. So those are not bad returns. And even if rates go up a little bit, you're just going to have a little degradation of that. So I actually think that you're getting paid in these markets for the risk.